Right now, somewhere in London, a vault manager is staring at inventory numbers that simply do not add up. In the high-stakes trading rooms of Chicago, phones are ringing with a sense of urgency that has not been felt in decades. Behind closed doors in Beijing, government officials are finalizing documents that will effectively reroute the flow of global commodities. While the general public is distracted by the daily noise of the stock market and social media, the wealthiest individuals and the most powerful institutions are suddenly scrambling to secure a metal that many forgot about years ago. This metal is not gold and it is not oil. It is silver. What we are witnessing today is a fundamental shift in the global financial architecture. For years, silver has been treated as the neglected stepchild of the precious metals family. It was suppressed by paper contracts and overlooked by mainstream analysts who claimed it was too volatile or irrelevant in a digital age. But the curtain is being pulled back. Last week, a single trading session saw silver move $7.70 higher. That is a gain of over 10% in just 24 hours. Such a move in a major global commodity is not normal market behavior. It is a distress signal. It is the sound of a system that has been stretched to its absolute breaking point. The current market price in the United States has climbed to approximately $79.34 per ounce. However, if you look across the ocean to the Shanghai Gold Exchange, the price for the exact same metal is trading at $85 per ounce. This $5 premium for physical delivery in China is a loud and clear message to the rest of the world. The East is hungry for physical metal while the West is still trying to settle its debts with paper promises. This disconnect is the beginning of what many experts call a systemic repricing. The tension is reaching a fever pitch because of a massive, looming deadline. In just a few days, on January 1st, China is set to trigger what can only be described as a silver kill switch. By imposing strict export restrictions and requiring government licenses for any silver leaving its borders, China is effectively claiming ownership over a critical piece of the global supply chain. This move has sent shockwaves through the banking sector. We have already seen reports of major financial institutions tapping the Federal Reserve Emergency Repo Facility for over $17 billion just to stay afloat. These banks were caught on the wrong side of a massive bet. They believed silver would stay low forever, and now they are facing a catastrophic liquidity crisis. In this video, we are going to peel back the layers of this unfolding crisis. We will explore why the London Bullion Market Association is facing an existential threat and why the delivery vaults in Chicago are under unprecedented stress. We will analyze why the world's richest man is expressing public concern about silver prices and what it means for the future of technology and green energy. Most importantly, we will look at the historical data and the technical charts that suggest we are entering a new era for silver. This is not just about a price spike. This is about the end of price suppression and the return to tangible value. On January 1st, the global silver market will face a structural transformation that most Western investors are completely unprepared for. China has officially announced the implementation of strict export controls on silver and silver-related products. These are not merely administrative adjustments or minor tax changes. This is the activation of a strategic resource kill switch. Under these new regulations, any entity wishing to export silver from China must obtain a special license from the central government. Historically, China has been a primary source of silver supply for the global market, acting as a critical link in the chain that feeds industrial centers in Europe and North America. By tightening the spigot, Beijing is effectively signaling that the era of cheap and abundant silver for the West is over. To understand why this move is so devastating, we must look at China's role as the world's factory. For the past decade, China has been systematically securing the supply chains for the technologies of the future. They have already done this with rare earth elements, with lithium and with cobalt. Silver is the final piece of the puzzle. It is the most conductive metal on Earth, and it is absolutely essential for the production of solar panels, electric vehicle components, and advanced telecommunications hardware. By restricting exports, China is ensuring that its domestic industries have priority access to the metal they need to dominate the green energy transition. This is resource nationalism on a global scale. The timing of this move on January 1st is particularly calculated. It comes at a moment when global silver inventories are already at multi-year lows. For the past 4 years, the world has been running a structural silver deficit, where the amount of metal mined from the ground is significantly less than the amount consumed by industry and investors. This deficit has been covered by drawing down existing stockpiles in vaults in London and New York. However, those vaults are now beginning to run dry. When China removes its supply from the global pool, there will be no backstop left. The market will be forced to find a price that is high enough to discourage consumption or encourage new mining, and that price is significantly higher than $79. The price action we are seeing in Shanghai provides a preview of the coming chaos. The $5 premium per ounce in China is a clear indicator that the local market is already pricing in the upcoming scarcity. In a functioning global market, arbitrageurs would buy silver in the West for $79 and ship it to China to sell for $85, pocketing a quick profit. The fact that this gap persists and is actually widening tells us that physical silver is not moving. The metal is being hoarded. Large buyers in the East understand that in a world of digital currencies and infinite debt, the person who holds the physical metal holds the power. As we approach the January 1st deadline, the pressure on Western exchanges is becoming unbearable. Every ounce of silver that China keeps within its borders is an ounce that cannot be used to settle a paper contract on the COMEX or the LBMA. We are moving toward a moment of truth where the financial world must realize that you cannot build a solar panel or a cruise missile out of a paper silver certificate. China has recognized this reality, and they are acting accordingly to protect their national interests. For the rest of the world, the January 1st ultimatum is a wake-up call that the foundation of the silver market has shifted permanently. As the calendar turns toward January 1st, the internal plumbing of the global financial system is beginning to leak. While the mainstream media remains focused on interest rate projections and political headlines, a much more dangerous drama is unfolding within the banking sector. The rapid ascent of silver to nearly $80 per ounce has triggered a catastrophic liquidity event for some of the world's largest financial institutions. Just last Friday, we witnessed a staggering $17 billion injection from the Federal Reserve's emergency repo facility to a group of banks that found themselves on the brink of a collapse. To put this in perspective, $17 billion in emergency liquidity is not a routine technical adjustment. It is a massive bailout for banks that made a fatal mistake. They bet against silver and they lost. For decades, bullion banks have used a specific playbook to keep silver prices under control. They held massive short positions on the futures markets, essentially promising to deliver silver they did not actually own. By flooding the market with paper silver contracts, they could suppress the price whenever it started to rally. This worked as long as investors were happy to settle for cash. But the rules of the game have changed. In late 2025, the physical demand for silver became so intense that the paper manipulation stopped working. When silver prices surged over 120% in a single year, the losses on these short positions became astronomical. The banks were no longer just losing money, they were losing their ability to function. The $17 billion borrowed from the Fed represents a desperate attempt to cover the margin calls on these failing bets. When a bank holds a short position and the price of the asset doubles, that bank must provide more collateral to the exchange to prove it can pay its debts. If the bank runs out of cash, it faces a forced liquidation, which would drive the price of silver even higher in a classic short squeeze. The Fed stepped in with billions of dollars in emergency funding to prevent a cascading failure that could have taken down the entire precious metals trading system. Without this intervention, several major names in the banking world might not have survived the weekend. This banking fracture is directly linked to the crisis in the physical markets. Traditionally, banks would lease silver from one another to cover their obligations, but today the lease rates have skyrocketed. In the London market, silver lease rates have reached historic levels as high as 30% on an annualized basis. This tells us that no one is willing to part with their physical metal even for a high interest rate. The banks are trapped. They cannot buy the metal to close their short positions because there is not enough physical silver available, and they can no longer afford to maintain their paper positions as the price continues its relentless climb. We are entering a phase where the stability of the banking system is being tested by a simple gray metal. The $17 billion secret is out, and it reveals a fundamental truth. The financial institutions that once controlled the silver market are now being controlled by it. They are in a race against time, trying to exit their positions before the January. First, export restrictions from China make it impossible to secure the physical metal at any price. For the intelligent investor, this banking stress is the ultimate confirmation that the silver market is no longer a game of paper and ink, but a battle for real, tangible assets. The global financial system is built on the principle of price uniformity. In a healthy market, an ounce of silver should cost roughly the same whether you are in London, New York, or Shanghai. This balance is maintained by a mechanism called arbitrage, where traders buy in the cheaper market and sell in the more expensive one until the prices equalize. However, as we stand at the end of December 2025, the global silver arbitrage mechanism has not just stalled, it has completely collapsed. We are witnessing a historic disconnect where silver in Shanghai is trading at $85 per ounce, while the Western price remains stuck near $79. This $6 spread is a massive red flag indicating that the global market is no longer a single, unified entity. It has split into two. In normal times, a $6 premium would be an irresistible profit opportunity for bullion banks and global traders. They would back up trucks to Western vaults, ship the metal to China, and pocket millions of dollars in easy gains. The fact that this is not happening tells us something terrifying about the state of Western silver reserves. The metal is simply not there to be moved. The vaults of the London Bullion Market Association and the Chicago Mercantile Exchange are increasingly filled with paper claims rather than physical bars. When Chinese buyers demand physical delivery and offer a massive premium, they are effectively draining the world of its remaining mobile supply. This divergence is not a random market glitch. It is a symptom of a deeper shift in economic power from west to east. For over a century, the West has set the price of commodities through paper futures markets like the COMEX. These markets allowed traders to influence prices using leverage and derivatives, often with very little physical metal actually changing hands. But the East, led by the Shanghai Gold Exchange, is changing the rules. They are operating on a physical first basis. If you want to buy silver in Shanghai, you must have the capital, and you often take physical possession. By maintaining a high premium, China is acting like a giant vacuum cleaner, sucking silver out of Western warehouses and into Asian vaults. The collapse of arbitrage also signals a breakdown in the logistics of the precious metals market. To move silver from London to Shanghai requires insurance, transport, and most importantly, a clear legal path. With China's new export restrictions and the increasing scrutiny of silver as a strategic national asset, the friction of moving metal has increased tenfold. The market is now pricing in the reality that silver in a vault in London is not the same as silver in a vault in Shanghai. One is a promise that might be settled in cash if things get difficult, while the other is a tangible asset held within a secure and resource-hungry jurisdiction. As the Western exchanges struggle to maintain their lower price points, they face a looming crisis of credibility. If the price of silver is $85 in the real world but your screen says $79, the screen is wrong. This creates a situation where institutional investors and even sovereign nations begin to bypass the Western exchanges entirely. They see the writing on the wall. The arbitrage collapse is the first stage of a global repricing where the true value of silver is determined by those who actually have the metal, not by those who have the most powerful printing presses. For decades, the narrative around silver was dominated by its role as a monetary metal or a form of jewelry. But in 2025, that narrative has been permanently shattered. Silver has officially transitioned from a luxury item to the most critical industrial commodity of the 21st century. If oil was the lifeblood of the 20th century, silver is the indispensable conductor of the digital and green revolution. Unlike gold, which is primarily stored in vaults as a hedge against inflation, over 60% of global silver demand now comes from industry. This is not metal that sits in a safe. This is metal that is consumed, ground up, and embedded into the technology that powers our world. The primary engine of this hunger is the solar energy sector. In 2014, solar power accounted for only 11% of industrial silver demand. By 2024, that share surged to 29%, and as we enter 2026, the growth is accelerating even faster. Modern high-efficiency solar cells like the TOPCon models require 50% more silver than older designs to achieve their performance targets. The world is currently on a path to install hundreds of gigawatts of new solar capacity annually. In China alone, the expansion is so massive that it is consuming hundreds of millions of ounces of silver every year. We are reaching a tipping point where the solar industry alone could eventually consume nearly half of all silver mined from the earth. The automotive sector is the second major pillar of this demand. An internal combustion engine vehicle uses between 15 and 28 grams of silver. In contrast, a battery electric vehicle requires between 25 and 50 grams. This means that every time a consumer switches from a gasoline car to a Tesla or a BYD, the demand for silver effectively doubles. This metal is found in battery management systems, power electronics, and the vast charging infrastructure that must be built to support millions of new electric cars. Elon Musk has publicly acknowledged the stress this causes. When silver prices spike by 10% in a single day, it directly increases the cost of every car and every solar roof tile his companies produce. Musk recently remarked that silver is a critical bottleneck, and his concern highlights a fundamental truth. You can print money, but you cannot print silver. Perhaps the most explosive new source of demand is the artificial intelligence revolution. While software and algorithms get the headlines, the physical infrastructure of AI is built on a foundation of silver. Data centers require high-performance semiconductors and circuit boards that can handle immense processing speeds without overheating. Silver is the only metal with the superior electrical and thermal conductivity required for these densely packed chips. Global information technology power capacity has increased over 50 times since the year 2000, and every gigawatt of that capacity requires massive amounts of silver hardware. This industrial demand is what economists call inelastic. A solar panel manufacturer or an electric vehicle company cannot simply stop using silver because the price goes from $30 to $80. There are no easy substitutes that offer the same performance. They are forced to buy the metal regardless of the cost to keep their factories running. This creates a permanent floor under the price and a constant drain on global inventories. As the world pushes toward a green and digital future, the industrial hunger for silver is no longer just a market factor. It is an unstoppable force that is rapidly depleting the world's remaining supplies. Whenever silver experiences a parabolic move, market skeptics immediately point to the year 1980 and the infamous saga of the Hunt brothers. For decades, this historical event has served as a cautionary tale used to frighten silver investors. Back then, Nelson Bunker Hunt and William Herbert Hunt attempted to corner the global silver market, using massive amounts of leverage to accumulate nearly 200 million ounces. They drove the price from approximately $6 per ounce to a record peak of nearly $50. However, the rally was built on a foundation of sand. It was a purely speculative play driven by two individuals rather than fundamental demand. When the regulators changed the margin rules on what became known as Silver Thursday, the bubble burst and prices collapsed. But the situation we are witnessing in late 2025 is fundamentally different from the Hunt brothers era. The rally 45 years ago was driven by a desire to manipulate a market for personal gain. Today, the price surge is being driven by a global shortage of physical metal that is essential for human survival and technological progress. In 1980, the world had massive silver stockpiles and very little industrial use for the metal outside of photography and silverware. Today, those stockpiles have been depleted by decades of deficits, and silver is a core component of the global energy infrastructure. We are not looking at a cornered market, we are looking at an exhausted one. Another critical difference lies in the behavior of the sellers. In the 1980s, as the price hit $50, people around the world stood in long lines at coin shops to sell their family heirlooms and silver tea sets. This massive influx of scrap silver provided a secondary supply that helped break the rally. In 2025, that scrap supply has largely vanished. Most of the silver produced today is used in such small quantities within electronics and solar panels that it is not economically viable to recycle. Once it is embedded in a circuit board or a solar cell, it is effectively gone from the market forever. We have replaced a circular supply chain with a linear one that ends in a landfill. Furthermore, the monetary environment today bears no resemblance to the 1980s. Back then, the chairman of the Federal Reserve, Paul Volcker, was able to break inflation by raising interest rates to 20%. This made the US dollar incredibly attractive and killed the demand for precious metals. In today's world, the global debt load is so massive that raising interest rates to even 10% would cause an immediate collapse of the entire global banking system. The central banks are trapped. They cannot use the Volcker playbook to stop this silver rally because doing so would trigger a sovereign debt crisis. When we look at the historical echoes of silver, we must realize that we have moved past the era of speculation and into the era of scarcity. The Hunt brothers were trying to fight the system from the outside using borrowed money. Today, the system itself is breaking from the inside because it can no longer provide the physical metal required to meet the demands of the modern world. The current breakout is not a temporary spike that will be followed by a 90% crash. It is a permanent upward adjustment to reflect the true value of a vanishing resource in a world of infinite currency. For decades, the global silver market has operated on a system of extreme leverage, where the amount of silver traded on paper far exceeds the actual metal held in vaults. In the halls of the COMEX in Chicago and the LBMA in London, traders exchange millions of ounces of silver every day through digital contracts. However, as of late 2025, this system of paper promises is facing its ultimate day of reckoning. We are witnessing a historic decoupling between the price of a silver contract and the price of a physical silver bar. This is not just a market fluctuation, it is an open rebellion against a financial structure that has suppressed silver prices for far too long. The data from December 2025 is staggering. In the first 4 trading days of the month alone, over 60% of all silver registered for delivery on the COMEX was claimed. This triggered what analysts are calling a physical vault drain emergency. For years, the banking institutions that act as market makers relied on the assumption that only a tiny fraction of contract holders would ever ask for their metal. They operated on a fractional reserve basis, similar to a bank. But when the world's industrial giants and sovereign wealth funds began demanding the physical bars, the illusion of abundance vanished. The market entered a state of steep backwardation, where the price for immediate delivery became significantly higher than the price for future delivery. This is a red alert signal that the system is running out of metal. In London, the situation is even more critical. The London Bullion Market Association is the world's central hub for physical silver. But in October 2025, lease rates to borrow silver surged to an all-time peak of nearly 35%. When lease rates are that high, it means the market is screaming for metal. It means that the institutions that normally facilitate silver trading are so desperate for physical inventory that they are willing to pay astronomical interest just to hold a bar for a few weeks. Reports have emerged that some traders even resorted to booking cargo slots on transatlantic flights to move silver bars between continents, a costly logistics move usually reserved for gold just to settle their obligations. The banking sector is caught in the middle of this war. Major financial institutions that held massive short positions betting that silver would stay cheap have been forced to tap the Federal Reserve standing repo facility. In late 2025, banks borrowed as much as $26 billion in a single day to manage their liquidity. While the Fed claims these loans are for general Treasury settlements, the timing correlates perfectly with the explosive moves in the silver market. These banks are facing a margin call of historic proportions. They are discovering that while they can print an infinite amount of paper silver, they cannot manufacture a single ounce of the physical element. This paper versus physical war is reaching a breaking point because of the transparency of the modern age. In the past, exchanges could hide their lack of inventory behind complex accounting. Today, the global community of silver investors and industrial buyers is watching the vault data in real time. They see the registered inventory dropping toward zero. They see the premiums in Shanghai rising. And they are reaching the same conclusion. The paper market is a lie. When the music stops, the only thing that will matter is who has the physical metal in their possession. The transition from a paper-based pricing system to a physical-based one is the primary reason silver is heading toward triple digits. To truly appreciate the magnitude of the current silver rally, one must step back from the daily noise and examine the long-term historical data. When we look at the 160-year chart of silver, starting from the mid-1800s, we see a pattern that should make every serious investor stop and pay attention. For over a century and a half, silver has traded within a defined psychological and technical range. Aside from a few brief spikes, such as the American Civil War era and the speculative bubble of 1980, silver has been largely suppressed. But in late 2025, that century-long dam has finally broken. We are no longer looking at a simple price increase. We are witnessing a once-in-a-lifetime structural breakout. For the past 13 years, the $30 level acted as an impenetrable ceiling for silver. Every time the price approached this zone, it was met with aggressive selling and paper manipulation. However, the price action in 2025 changed everything. Silver did not just tap $30, it blasted through it, transformed that resistance into support, and then surged past the $50 mark, a level that had held since 1980. By December 27, 2025, silver hit approximately $79.31 per ounce. This is what technical analysts call price discovery. When an asset breaks a multi-decade resistance level, there is no historical map to tell us where the new top will be. The market is effectively rewriting its valuation of silver in real time. One of the most powerful indicators confirming this breakout is the gold to silver ratio. Historically, this ratio tells us how many ounces of silver it takes to buy 1 ounce of gold. For much of the past decade, the ratio was stretched to extreme levels, often exceeding 80 or even 100 to 1. This signaled that silver was historically undervalued compared to its yellow cousin. As we enter 2026, this ratio is collapsing. It has already dropped below 65 to 1. Historical precedent suggests that during major precious metals bull markets, this ratio tends to gravitate toward 30 or even 15 to 1. If gold continues to trade near record highs above $4,500, a reversion of the ratio to historical norms would imply a silver price well into the triple digits. The technical charts are also showing a rare momentum signal known as a vertical expansion. While the first half of 2025 saw a steady climb, the final quarter of the year has turned nearly vertical. This type of movement is often driven by forced repositioning, where short sellers are squeezed out of their positions and industrial buyers are forced to panic buy to secure inventory. The monthly Relative Strength Index, or RSI, has climbed to its highest level since 2011, indicating extreme strength. While some traders fear this means silver is overbought, veteran commodity experts know that the most explosive gains often occur when an asset stays in overbought territory for an extended period. If we apply measured move projections from the massive 13-year consolidation base, the technical targets are staggering. The first major objective sits at $88, followed by an extension toward $120. Some long-term models, adjusted for the massive expansion of the global money supply since 1980, even point toward a potential of $400 per ounce in an extreme scarcity scenario. While those numbers may sound like fantasy today, remember that silver was only $28 at the start of 2025. It has already tripled. When a 160-year breakout occurs, the move is rarely measured in pennies, it is measured in multiples. As we stand at the final days of 2025, we are witnessing more than just a commodity rally. We are witnessing the unfolding of the fiat endgame. For over 50 years, the world has operated under a monetary system where currencies are backed by nothing but government decree and collective faith. But as global debt levels soar past $350 trillion, that faith is beginning to dissolve. The rapid rise of silver and gold in late 2025 is the market's way of casting a vote of no confidence in the sustainability of the current financial order. We are entering a period where the preservation of wealth is becoming more important than the pursuit of profit. The evidence of this endgame is visible in the behavior of the world's most sophisticated financial actors, the central banks. Throughout 2025, central banks have continued a historic buying spree, accumulating over 1,000 tons of gold for the fourth consecutive year. But the real shockwave came when the Russian central bank officially announced the inclusion of silver in its state reserves, a move designed to sanction-proof its economy and diversify away from Western-controlled fiat assets. When central banks, the very architects of the paper money system, begin hoarding physical silver and gold, it is a clear signal that they are preparing for a world where paper claims may no longer hold their value. The reason for this shift is simple mathematics. In 2025, the interest expense on the United States federal debt reached a staggering 13% of all federal receipts. This means that an increasing portion of every tax dollar is being used just to pay interest on past borrowing, rather than investing in the future. Historically, when a nation reaches this level of debt saturation, there are only two paths forward: outright default or the systematic devaluation of the currency through inflation. Since no government wants to admit default, they choose the hidden tax of inflation. By printing more money to cover their obligations, they dilute the purchasing power of every dollar, euro, and yen in existence. Silver acts as the ultimate pressure relief valve in this environment. Unlike a government bond or a bank deposit, silver has no counterparty risk. It does not require a promise from a politician or a bank manager to be valuable. It has intrinsic worth derived from its scarcity and its essential role in the modern industrial economy. In 2025, silver has outperformed the S&P 500 by a factor of nearly 3 to 1, proving its effectiveness as a wealth preservation tool. While the stock market may reach new highs in nominal terms, when measured against the price of silver, most traditional assets are actually losing ground. For the intelligent investor, the end game is about moving out of the splash zone of failing fiat experiments and into the safety of tangible assets. We are seeing a great rotation where capital is fleeing the uncertainty of digital ledger entries and seeking the security of physical bars and coins. This is why we see the massive premiums in Shanghai and the vault drains in London. People are waking up to the reality that in a world of infinite paper, the only thing that will retain its value is that which is finite. Silver, with its dual identity as a monetary anchor and a technological necessity, is uniquely positioned to protect your labor and your legacy as the fiat era reaches its inevitable conclusion. As we approach the threshold of 2026, the silver market has fundamentally transitioned from a state of quiet accumulation to one of global mania. With the price currently sitting near $79.35, marking a staggering 170% gain since the beginning of the year, investors must shift their mindset. The strategies that worked when silver was $25 are no longer sufficient. In this new era of triple-digit targets and systemic shortages, the intelligent investor must prioritize clarity, discipline, and a long-term vision over short-term greed. The first pillar of a successful strategy is understanding the difference between price and value. While the dollar price of silver may fluctuate wildly in the coming months, its value as a non-substitutable industrial asset and a finite monetary reserve has never been higher. For those who have been accumulating for years, current levels represent a massive validation of their thesis. However, for those entering the market today, it is crucial to avoid chasing vertical moves with money you cannot afford to lose. Market history teaches us that even the strongest bull markets have sharp corrections designed to shake out weak hands. A prudent approach involves gradual accumulation during periods of consolidation rather than buying at the absolute peak of a news cycle. The second pillar is the focus on physical possession. The events of late 2025, the vault drains in London, the delivery failures in Chicago, and the export restrictions in China have proven that paper claims are not the same as the metal itself. In a systemic crisis, a brokerage statement is just a digital promise, but a silver bar in your hand is a completed transaction. As the gap between paper and physical prices widens, the premium you pay for physical delivery should be viewed not as a cost, but as an insurance premium for certainty. Diversifying your holdings across physical bullion, specialized silver ETFs that are fully backed by metal, and high-quality mining companies can provide a balanced exposure to both safety and growth. Looking ahead to 2026, the path toward $150 per ounce appears increasingly realistic. The structural deficit of over 200 million ounces, combined with the silver kill switch activated by China on January 1st, creates a supply vacuum that cannot be easily filled. When you add the cooling of the US dollar and the anticipated interest rate cuts by the Federal Reserve, the macroeconomic tailwinds for silver are at their strongest in 40 years. We are not just watching a price spike. We are watching the market finally correct a multi-decade suppression. In conclusion, the silver story of 2025 is a warning and an opportunity. It is a warning that the era of infinite paper and cheap resources is ending. It is an opportunity because those who recognize the shift early have the chance to protect their wealth in an asset that the modern world cannot function without. Whether silver hits $100 in 6 months or 18 months is less important than the fact that the trend is now irreversible. Stay disciplined. Keep your eyes on the physical fundamentals, and remember that in a world of digital illusions, silver remains the ultimate conductor of truth. Thank you for joining me on this deep dive into the most important market story of our time.